Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our lesson on IFRS 13, Fair Value Measurement. Now, in the part 1 of this lesson, we introduced you to the basic concepts and principles of IFRS 13, and then we looked at the measurement levels, level 1 inputs, level 2, and then level 3 inputs, of which we took a simple question to try and understand better. Now, in this video, what I'm going to do is that I'm going to talk about markets, and then we'll take a question that relates to markets, okay? And then we'll conclude with some notes on the fair value of a non-financial asset, after which we'll also solve other examples that relate to the concepts we have studied so far in part 3. So without wasting my time, let us look at what I mean by markets. Now, fair value measurement has its premise based on markets. What we are trying to say is that the price to be received for selling an asset or the price to transfer in payment of a liability may differ depending on the type of market in which you can find it. We have said that fair value has to do with the price to be received from the sale of an asset or the amount to be transferred in settlement of a liability in an orderly transaction between market participants at the measurement date. So what we are trying to say is that once there are market participants in the definition, we need to pay attention to the market aspect of the measurement of fair value. Now, there are two basic markets. So let me just say markets. I'm going to explain the markets to you and what IFRS 13 says about that market for the purpose of solving a question. But first of all, let us look at the types of the markets, and then I'll explain each type, and then we would solve a question. Now, we have two main markets to consider. We have the principal markets, and then we have the most advantageous markets. So, for fair value measurement, we have the principal market concept and we have the most advantageous market concept. Now, what is the principal market? I'm going to explain to you, and then that of the most advantageous as well. Now, the principal market is the market that has the most activities for the asset being sold. It is the market with the greatest activity. So, the market with the greatest activity for the assets or liability. Now, the market that has the greatest activity for that particular type of asset that you are going to measure at fair value is what we call the principal market. So there can be so many markets for selling cars, okay? But if the market A, market B, and the market A is the market where most cars are traded, but market B doesn't have a lot of activity of trading of cars, then we can say that the principal market should be the market where most of them are traded. For example, if you come to Ghana, Accra to be precise, we have a market for spare parts of vehicles at Abosiokai. And when we say it's a market, you could see that it's a very big environment where there are a lot of shops that are selling car parts. And we can say that if there is another place in a different area where people have opened shops for car parts, but where people have opened shops for cars, but when people want to buy car parts, we can see that 90% of them will go to Abosiokai and only the 10% may go to the other markets. Then it means that the Abosiokai market becomes the principal market for the sale of car parts, and the other markets may not be that much. So in this case, in valuation of fair value for any asset or liability, the standard IFRS 13 says that it should be, the focus should be on the principal market. I'll come to the most advantageous market. The principal market, because it is in the principal market that most activity or the greatest activity for that particular asset that you are valuing is being done. So if the valuation is being done on this asset, and this asset or liability is the greatest activity for sale and purchase of this asset is done in market A, but in market B, the sale and purchase of it happens once a while. Then we are saying that the principal market will be market A because the greatest activity for that particular asset is happening on that market. And therefore, it means that if you want to find the value or the price of the asset, we can rely on the price that is coming from market A more than the price that is coming from market B. And that is why the standard says that the focus is that we should pay attention to the pricing on the principal market than any other market. I hope you are getting it. So the general rule is that IFRS 13 says that pricing of or fair valuation of assets and liabilities should make reference to the principal market. So we should always make reference to the principal market in the valuation of assets and liability, in the fair valuation of assets and liabilities. That is what we are saying. So I'm sure the principal market concept has entered. Now let's talk about the most advantageous market. The most advantageous market is the market that will maximize the proceeds to be received from the sale of the asset or minimize the amount to pay for the liability. So now, the most advantageous market could still be the principal market or any other market. When we say most advantageous market, it is the market that will maximize the cash to be. So let's assume that you want to go and sell your vehicle. And there is market A, market B, market C. Now, market A may be the principal market. But if you weigh the cost that is involved in transporting to sell in those markets, the proceeds you are going to get from the sale in every market, depending on the prices that are prevailing on the market. And let's assume that market A being the principal market, you are going to get $1,000 from the sale of the asset. Market B, you are going to get 1,100. Market C, you are going to get $900. Now, let's assume that you are going to sell, if you want to sell that particular asset, you are going to realize 1,000 as cash proceeds from when you sell it in market A. When you sell in market B, you are going to get a net proceeds of 1,001, and market C is going to give you a net proceeds of 900. In that case, market B becomes the most advantageous market because it is the market that is maximizing the amount you are receiving from the sale of the asset. So the most advantageous market is that market that will maximize the amount you receive from the sale of the asset. However, market A could be the principal market. Market B could still be the principal. Market C could be the principal. So it doesn't mean that the most advantageous market should not be the principal market. The most advantageous market could still be the market that has the greatest activity for the asset or liability. However, there are instances where the principal market may not be the most advantageous. So even though A could be the principal market, however, it could be that B rather is the most advantageous market. So whenever you are giving the values for market A, market B, and you want to base on that to do fair valuation of your asset or liability, are we going to go by the principal market price or the amount to receive from the most advantageous market? Now, I maintain that IFRS 13 prescribes that even though there may be a most advantageous market, however, it is the principal market that should be the point of reference for the fair value of any asset of liability. So in estimating the fair value of any asset or liability, IFRS 13 says that it is the principal market that should become the point of reference, whether another market will give you a greater return or not. However, where there is no principal market, then we can value it from the most advantageous market. I don't know if you are getting it. The only time we are going to use the most advantageous market as a reference is when in all the markets, none of them is established as a principal market. So if none of these markets has been established as a principal market, then we are going to base on the most advantageous market to do the fair valuation. But if there is a principal market, it doesn't matter the return from other markets. Once, even if it's a market C that is established as the principal market, we are still going to base on $900 as the fair value of the asset, even though the market A and B is going to give higher returns. However, once this is the principal market, we are going to go by that. The only time we will deviate from the principal market is when there is no principal market at all. Then we will look at the most advantageous, and then our fair value is going to now be based on the 1,100. I'm sure this is very understandable. Okay, so having understood the principles of the principal or concept of principal market and most advantageous market, let us look at a question that illustrates these market situations, and then let's see how best we can solve that. So an asset is sold in two different active markets at different prices. An entity enters into transactions in both markets and can access the price in those markets for the asset at the measurement date as follows. So we have market 1 and 2, and so each of them we have the price. So in market 1, you can sell it at a price of 26 cedis. In market 2, for a price of 25 cedis. However, transaction cost in market 1 is 3 cedis, and it will cost you 1 cedi in market 2. Transportation cost is 2 cedi in both markets. Therefore, the net price to be received is that market 1 will be 21 cedis price to be received, and market 2 is 22 Ghana cedis. We continue. What is the fair value of the asset if A, market 1 is a principal market for the asset, B, no principal market can be determined? So this is a very simple question, but I want to let you understand something. Now, you could see that in market 1, okay, in market 1, the net proceeds to be received is 21 cedis after taking out transaction costs and transportation costs. In market 2, the net proceeds is 22 cedis after taking out the transaction costs and the transportation costs. And the requirement is that what is the fair value if A, market 1 is a principal market of the asset? Now, there is a rule with transaction costs, and I'm going to explain to you. So let me clean this. Now, you could see that. Now, let me just repeat something for you. Now, this is market 1 from the question, and this is market 2. Now, in market 1, the price is 26 cedis and 25 cedi in market 2. And then there is transaction cost. The transaction cost in the question is 3 cedis for market 1 and then 1 cedi for market 2. And then there is transportation cost, which is 2 cedis for market 1 and 2 cedis for market 2. So giving us a net price to be received of 21 cedis for market 1 because we are subtracting the cost, and then 22 cedis for market 2. Now, if you look at this, you will see that if there is no principal market here, then market 2 is the most advantageous market because market 2 gives us a higher net price to be received. Okay. However, the question says that the first requirement says we should assume that market 1 is the principal market. Therefore, fair value will be based on market 1 because regardless of whether the net proceeds here is higher or not, the IFRS 13 says reference should be made to market 1 in the valuation of the asset. Now, there is an exemption to transaction costs when it comes to fair value measurement. And this is what the law, IFRS 13 or the rule says, that even though transaction costs are included in determining which market is the most advantageous in terms of the net price received, it should not, transaction cost should not be factored in the actual valuation of the assets. So, in determining whether market 1 or 2 is the most advantageous market, you realize that we have subtracted the transaction cost to get to make us understand that market 2 will give us a higher net price received. However, if we are doing the actual valuation, we are not going to include the transaction price. Let me solve it and you understand. So, solution to the question. Look at the requirements again. A, What is the fair value of the asset if A, market 1 is a principal market for the asset? So here, market 1 is a principal market. And regardless of what market 2 is bringing us, once market 1 has been established as a principal market, then the IFRS 13 says that valuation should be based on market 1. So therefore, the asset will be valued at the price of 26 cedis minus the transportation cost of 2 cedis, which will give us a final answer of 24 cedis. So therefore, you write that the fair value of the asset will be 24 cedis. Did you notice that I didn't take away the transaction cost? I only took away the transportation cost. Because IFRS 13 says that transaction cost should not be included in the valuation of the fair value, or determining the fair value, sorry. But it should be included in determining which market is the most advantageous. So in determining the most advantageous market, we need to subtract the transaction cost to determine which one gives us the higher net price received. However, in writing the actual fair value, we are not going to subtract the transaction cost. It is only giving us a guide as to which one is giving us a lower or higher net return in relation to only when we are dealing with the most advantageous market. But once the principle is that we should always make reference to the principal market, and it is established from requirement A that we should assume that market 1 is a principal market, then we are going to do the valuation based on the figures from market 1, and in doing so we are going to subtract only the transportation cost from the price of 26 cedis, and that is going to give us a final fair value of 24. If you subtract the transportation cost again, you are going to get the 21 cedis, but it is wrong. It doesn't mean that the net price received of 21 cedi is necessarily the fair value of the asset. It is only there. The transaction cost was included in the deduction only to determine which of the markets is the most advantageous. So it's not about the figure that is there, but it's about obeying the rule that this is the principal market. So once there is a principal market, we don't even care about the total cost that is being received, or the total price, net price that is being received. We only establish the fact that if market 1 is the principal market, then the fair value of the asset will be the price minus the transportation cost, because the transaction cost is not a characteristic of the asset. That is what IFRS 13 is saying. So this is the answer for the first requirement. But you have to explain. I told you for standards, you write English to explain why you have excluded the transaction cost, which will be part of the marking scheme. Then requirement B. What is the fair value of the asset if B, no principal market can be determined? So in this case, requirement B is telling us to assume that none of the markets is the principal market. So therefore, the rule in IFRS 13 is that where there are no principal markets, valuation should be based on the most advantageous market. And the most advantageous market is the market that gives us the higher net price received. So therefore, market 2 is now the most advantageous market. Still, when we are doing the valuation, we are not going to include the transaction cost. It is only there to determine the most advantageous market or otherwise. Okay, so therefore, valuation will be the price of 25 cedis minus the transportation cost of 2 cedi. So therefore, valuation for fair value will be 23 Ghana cedis, because we didn't subtract the transportation cost. Did you notice that even though we are using the most advantageous market, this is giving us a lower fair value than when we use the other market that is not the most advantageous? But because the transaction cost is inclusive, it plays an important role in telling us which of the market is the most advantageous. So even though market 2 is the most advantageous market, we know that in principle, market 1 will give us a higher fair value, but we don't care. Once it is not the principal market, the basis for fair valuation is the market 2, which is giving us 23 cedis because it is the most advantageous market. So the general principle is that where there is a principal market, you base on that to do your valuation, but you exclude transaction costs in the actual valuation. Where there is no principal market, you base on the most advantageous market to do the valuation, but you also ignore the transaction cost. However, transaction cost is important in determining which market is the most advantageous. Okay. Okay, so this will bring us to the end of part 2 of our lesson on IFRS 13. Now in the part 3, I'm going to solve a bigger, complex question that involves the levels of input. I know some of you are requesting for bigger examples of the measurement using the levels of input, and then we are also going to look at other examples on the market, and then I'm also going to highlight finally on the fair value of a non-financial asset. Remember to subscribe to this channel if it is your first time. Share this video and let others also have a benefit. And until we meet again for part 3, it's bye for now. Thank you.